Hello and welcome to the second of our CIMA F3 Financial Strategy lecture recaps. Okay, this lecture was on financial sources or sources of finance. Okay, so let's get straight in with the criteria for your sources of finance. First thing you're going to be concerned with is the cost. How much is this finance going to cost you? Okay, are you going to be able to provide the return that investors want if you're issuing bonds, for example? What interest is going to be payable on it? Are you going to have to pay dividends if you're issuing equity? And think about your creditor hierarchy, okay? The secured and unsecured debtors right down to your ordinary shareholders. Okay, the second criteria you'll be looking at is the duration of the debt. Remember we looked at matching, and this is matching your long-term debt with your long-term investments and your short-term debt with your short-term investments. Long and short-term investments. Okay? We also then had to think about security. Are you going to secure this debt, or is it going to be unsecured? Obviously, raising finance is going to have an implication on your gearing, and we'll look in more detail at gearing, but it's the ratio of debt to equity and dictates your financial risk. Also, you've got to consider, is the debt available to you? Some firms may find it difficult to actually raise finance. Okay, so those are your criteria that you'll look at when you want to raise some finance. So, if you want to raise some equity, well, you're going to use the capital or stock markets. The functions of the stock market, well, the first primary function is for the company to raise capital and for investors to buy equity. Okay, the secondary function is that shareholders can sell out. You know, someone who has put a lot into a firm, maybe in the form of setting it up and then bringing it to the market, is able to sell his shares and realise a return. It's also a way to assess the performance of a business. Okay, the advantages of a stock market listing for the company, first of all, it's a source of new funds. It gives you a better standing. You know, people are more willing to trust you because you have to adhere to all the regulations and so on. You can issue equity to raise funds, and it should lower the cost of doing that. The advantages to the shareholders: firstly, you can sell your shares. Secondly, the shares may have more value simply because they're more marketable. There's a market for them. It's also easy to value your shareholding, for example, for capital gains or inheritance tax, any of those things. If it's listed, it's easier to value. Are there any disadvantages then? Well, it's quite costly to list. It's the first disadvantage. To actually get onto the stock market is quite costly. Secondly, you have the cost of constant compliance to stock market rules and regulations. You've also got diluted control. You know, if you just had 3 or 4 shareholders, you bring the business to market, and you dilute your controls. You're not able maybe to do exactly what it is you want to do. You're also open to public scrutiny. Not that that's always a bad thing. Okay, a little bit about the alternative investment market. This is really for what's called small cap or small capitalization shares. It's operated by the London Stock Exchange. It's a way for small companies to raise the finance that they need and for people to invest in small companies. And it lists all types of security for these companies. Okay, moving on then to methods of raising equity finance. The first method we'll look at is the rights issue. It's the right to buy shares. You'll buy them in the same proportion as the holding you currently have. For example, a 1-for-4 rights issue gives you the right to buy 1 share for every 4 that you own. Why might you raise finance in this way? Well, it's got a low cost in comparison to other methods, and you don't change the ownership. Because it's your existing shareholders who are buying the shares, it shouldn't change your ownership. Another method is an offer for sale at a fixed price, an offer for sale by tender. or a placing. This means you place your shares with institutional investors and give them quite a good price because you've got reduced cost of issue. Okay, so those are your methods of raising equity. Looking more closely at a rights issue, you'll find that with the rights issue it will affect your share price. Your share price is likely to fall, and that's due to uncertainty. You're going to have uncertainty because it's going to dilute your earnings per share because there's more shares. Will it affect your future profits? And will it affect future dividends? All of these will combine to cause uncertainty and to lower the share price. So when we lower the share price, can we calculate how low it will go? Well, yes, we use the theoretical X rights price calculation, which we looked at in class, and we have an example in the notes. Have a look at that if you're not sure how to do it. Okay, the shareholder options under a rights issue. Well, the shareholder can exercise the rights and take up the shares. They can sell the rights. They can part sell the rights, or they can do nought. Now, if they don't do anything, usually the company will have the ability to sell the rights on behalf of them so that they don't lose the value of the rights issue. Okay, so that was a little more detail on rights issues. Moving on to debt finance. The first issue with debt finance is it going to be secured? You can have fixed security, which will be over a specific asset, or floating security, which is general and over non-specific assets. You may want to, or you may have covenants issued in the debt, for example by banks. They may restrict the amount of dividends that you're allowed to pay. They may restrict some of your ratios, for example your gearing, and they may restrict other debt. You may not be allowed to raise other debt in return for them issuing you with debt. So types of debt, and we'll look at these in more detail later. But you can have bank finance. Remember that this is tax deductible, the interest is tax deductible. Or you can issue debt to the market. Types of issued debt are debentures, unsecured loans, mezzanine finance, which is a split between debt and equity, Eurobonds, which is debt issued in a foreign currency, or convertible debt, debt that can be converted to equity at a later date. A couple of points to note on debt being issued is that it's issued in units of £100 for the purposes of the questions. £100 is the nominal value therefore, and the interest is paid on the nominal value. So for example, if you're paying 7% interest, it'll be 7% of £100, not the market value of the debt at that time. Okay, so that is a little bit about debt. We then went on to look a little bit at a firm's treasury function. Now the role of the treasury function is to issue financial objectives. It'll also manage the liquidity of the firm, the working capital and so on. It'll determine the funding policy, and it'll manage all of your currency risks if you operate in foreign markets. The question that often comes up in exams is, should you centralise your treasury function? Well, on the pro side of this, you may get economies of scale through the volume of cash that you would be using. You're able to bulk borrow. It may reduce your foreign exchange risk, and you will get the expertise of a centralised function. You're more able to employ experts. On the other hand, you'll not have local control, so if you have local branches or divisions, they lose control of their own treasury function. It can lead to bureaucracy. You have to go through endless form filling to actually do anything, and it may be impractical. It may take too long. So that was our second lecture on sources of finance.